Well, let's not forget about commercial. Now, I'm going to tell you, commercial is not in the news as much as housing because it affects so fewer people, but the investors are taking a bath, and the ones that refinanced, like 5 or 6 years ago, that transferred all that liability to the lenders, they're chuckling because they're giving those towers back to the banks, and the banks are taking major losses. And I'm talking way more than any house is going to get. We're hearing 100 million, 200 million, $300 million in losses. This is called deflation because you have defaults. The money just gets destroyed. And it's all over the place. We've been talking about it kind of peripherally. I haven't really done too much on commercial, but the asset model is a asset model. So the timing model is not just housing, it's an asset model. It talks about the real estate asset, and commercial went into housing, went into the downturn about 6 months to a year ahead of housing, and commercial is just getting shellacked. And a lot of it has to do with occupancy, of course. These things are sold on income. When nobody's going to the office and nobody's renting those offices, they don't need them, man. When they have vacancy. So vacancy, I'm going to talk about this. I'm probably ahead of myself, but vacancy went to an all-time high maybe 6 months ago, about 19.6%. And it's over that now. It's over 20%. And here's the kicker, is that a lot of these tenants that are renting vacant office buildings, they are Fortune 500 companies, and they're honoring their leases because they're Fortune 500 companies. Now, the moment that they quit honoring those and their leases run out, you're going to see this vacancy skyrocket. And then you're going to see all these people who own buildings that are sitting vacant. When that vacancy goes from 20 to 40, holy cow, the value of that building just plummets. Here's the other thing, is that when you get returns, these are sold strictly on how much income does this building give me? We do that too on a much smaller basis. How much do I earn buying this building? And when the earning drops, the value of that building goes down. But what happens when cap rates go up, which means that my alternative investments are higher? So we used to get a 4.5 cap rate and think, oh man, that was pretty good. When you had a treasury that was at 1 or 1.5 or 2, you're getting double what the treasuries are. Now treasuries at basically almost a risk-free investment are running 4. Well, these cap rates, you can't get a 4.5. You're going to have to go higher. So cap rates are going higher as interest rates go higher. So as interest rates, it's a double whammy, man. It's just dooming the commercial, just dooming it. So as interest rates come up, you are competing with other risk-free investments. That means the cap rate has come up. As cap rate comes up, the prices get compressed. And of course, when you don't have as many people paying rent, that means that the income is also compressing it. So they're getting a double whammy. This is where you're seeing these buildings that are selling, they're selling 80% of what they were appraised for 5, 6, 7 years ago. And lenders are taking a bath. And it's not really advertised. Let me open this up a little bit, and we'll talk about this just a little bit. And you can see what we're talking about, because I think we're going to go severely much, much lower. It's coming. Commercial leading the way, of course. So this is just a small list of the endangered cities. Chicago, of course. I mean, Chicago's in the news every day. But Milwaukee, Minneapolis, I've got investors. They don't want to do business in Minneapolis anymore. Almost impossible to do business in California. Los Angeles, San Francisco, San Diego now is on the list. Seattle and Portland, of course, these are tough. And you start going into the East Coast, New York, New Jersey, Washington, D.C., and Philadelphia, very, very difficult to do business with it. So we are seeing lots and lots of people bailing from these places. Now, I got this from Zero Hedge. It was by Quoth the Raven, and it's called Race to the Dung Heap. This is just a few of their things. They're talking about, they're giving specifics. So here's an 18-story tower on 9th Avenue that sold in April 2025 for $100 million. But in 2018, where they financed it, it was $269 million. So someone paid $169 million less than what it appraised for, well, 7 years ago. Same thing in San Jose, which is, of course, in Silicon Valley. just closed May 25th, so fairly recently. Sold for $63 million, down from $163 million, $100 million loss. Now, you don't have to lose too many $100 million losses to have a significant drop. And I know I saw this one too. This was just truly amazing. Was the Chevron in Houston is a very nice location too. Sold for $18.2 million just in June. So that's like 3-4 months ago, down from $130 million. So someone lost $110 million. And in San Francisco, I don't want to go on and on. This is August. So Manhattan 1 was reappraised at $345 million, just 20% of its 2018 price. So these things cause major problems for the lenders. So when you just look at that, you can see that they lost probably $1 billion in lenders. And this doesn't take into effect, these are the sales price, but within the sales price, of course, when the lender gets these buildings back, they have to maintain them. If you got an elevator building that's 40 or 50 stories tall, can you just imagine that's millions of dollars a month in maintenance on it? You paint them and clean them and take care of them. Got insurance costs, maintenance costs. An elevator costs you a fortune. And of course, what happens is this is infinite returns. So this is a strategy for investors. If you buy for $100 million and you can get reappraised for $150 million, well, you get your 20% back. And you refinance for the old loan plus your down payment, and you transfer that all the liability to the lender. Infinite returns. And when buildings go bad like this, if they don't have a clause that protects the lender, which most of them don't, the lender gets shellacked for millions and millions of dollars. A lot of these are small lenders. A lot of these are regional. So a problem coming. This takes money right out of the economy. It just disappears. You understand? It just disappears. This is what happened in 2008, 2009, 2010. This is one of the reasons that the Federal Reserve put all that money in, because they had to replace the stuff that was being destroyed. And that's why we didn't have inflation for many, many years, because we really had deflation. This is coming. Now, let me just open this up a little bit so you can see this. So the talk on the street is the fact that we're going to need a bailout. And that's from the commercial mortgage-backed securities. And it's just brutalized out there. So let me go to my next slide and let's just talk about that. Now, I got this from John Rubino actually today. It was just a phenomenal article. And if you're not following John Rubino, you really should. He's a great American thought leader, brilliant man. He has a free Substack, and you're welcome to follow him. But he's saying that in the Google searches is that I'm in trouble and I need help with my mortgage. There's been 1.7 million delinquent homes. Do you think that has something to do with why we're getting a Google search that says I need help with my mortgage? 1.7 million delinquents. And I'm telling you that we're going to have FHA in recent years or in following years. They're going to be the new subprime, because, the Biden administration just made a mess of everything. 1.7 million homes went into loss mitigation from these guys. I talked about this before because I'm just astounded by this. Here we have FHA, 3.9 million mortgages during the Biden administration. Well, kudos to them, 3.9 million. That's great. American home ownership. But 1.7 million went bad. 40%. Now, can you imagine that if you hired a money manager and he lost you 40% year after year after year? Would you still maintain this guy? And yet Biden administration did. It just got worse. And of course, they never foreclosed. So we have all these. We have 1.7 million, and it's going to get worse. That's just FHA. They violated all the rules. So I mean, what did you expect? And this is coming to roost. We are going to see this, and this is housing. So when we start talking about our timing models, we are really expecting things to get bad. And I've talked about this before. During 20 and 21 and parts of 22, they didn't even appraise them. So people were paying stupid money. 20, 30, 40, $50,000 over ask just so they could buy a house. You remember the mania that was going on. I've talked about this just the other day. By the way, if you like my videos, if you subscribed, that would really help. We're not going to chase you. We're not going to try to sell you anything, but subscribing really helps with YouTube. And we're entering into this crazy, crazy period where we're going to see all kinds of things happening. It's going to be a pretty interesting time frame. I could make a video almost every day of all the stuff I see. It's just truly amazing. Anyway, we're seeing people, and this is it's just the death spiral. So when you have people that can't afford to repair their homes, that means that you start seeing cars in their front lawn that haven't moved in 3 or 4 months because the transmission doesn't work. You start seeing the paint start fading and it start to peeling, and people don't repair their hot water heaters, and they don't repair the AC, and then you start having problems in the neighborhood. And these are the ones that are going to be forced to sell, and they're going to set your comps. They're going to set your values. These people who can't afford their house, you get 3 of those in your neighborhood, they are going to set the comps. And I'm telling you, it's a doom loop. There is nothing to talk about. Prices are coming down. So I've been telling you, if you need to sell your house, you should have done it 2 years ago. You're 2 years behind, Sam. And if you need to do it, you better do it right away, because it is going to be less money next year in the spring during prime time than it is now. So talk to your brokers. If you're in one of these endangered cities, ask yourself why. Why am I in this endangered city? Crime's high, taxes are off the roof, and of course, business is very, very difficult to do. So either sell that portfolio or do a 1031 exchange and just transfer your capital gains to another property. It's very inexpensive to do. Get into a much better market. You can come here and get into a much better market. But there's great markets around the country that have much better. We have decades-long growth. So I'm telling everyone that we're not immune. We're going to have problems here in Phoenix. But it's going to be an opportunity for you. If you got stuff that's already going to be in the market that's seasoned, they call it seasoned capital. If it's in Chicago, it's at risk in Chicago, it would be at risk here in Phoenix. You might as well put it in a place that's going to have great long-term work potential for you. Let me go to my next slide so we can take a look at that too. So look at employment is falling out of escrow, or a lot of things falling out of escrow too. Employment is falling out, and I got this again from John Rubino just today, starting to see even the government, and it's in the news, so you just need to pay attention. You need to pay attention. We're talking about your future here. We're talking about millions of dollars in investment. You need to pay attention. The government's not hiring. And if you listen to everybody, we've got states that are on our risk parameters that they may not be able to pay their bonds. I'm hearing that in Chicago and in Illinois, if you pave a street, you get paid 2 years later because they don't have any money. So these places are greatly at risk. That means that they're not hiring. They're probably not going to be paying their pensions either. So you need to really pay attention. It's in the news. You just need to connect the dots, because odds are if you're a pensioner, one of these endangered cities, one of these endangered states, and you're counting on a nice, healthy pension from the government that can't pay its bills. Us old guys, we're the target. We haven't got much longer. They're hoping we're going to die before we collect. So I get a lot of calls, and I have a lot of people want to consult with us because they're concerned about their future, and rightfully so. Let me go to my next slide, and let's just talk about that. So again, we're seeing games here. We talk about the Biden administration and how we couldn't rectify what we see in real life with what their models were saying, and we find out that they were lying to us for over 1 million. This is one of the ways that they lie to us, is that they take employment, and if you're unemployed, they move you on to long-term unemployed, so that you're not counted in the 4.2% unemployment, because you're no longer you're in U6, not U2, And so you don't get counted in unemployed, you're long-term employed. So if they can move you to long-term unemployed, keeps the rate of unemployment down. It's just semantics. It just drives you crazy. So we're seeing all these people going on to long-term unemployed because they can't find a job. So employment is really softening up. And let me go to the next slide. There is no way that you can miss this either. Just look at this. If you were employed, you wouldn't have this high credit card debt. You wouldn't be tapping your savings account, and you wouldn't be withdrawing from your IRAs. That doesn't go with high employment. That just doesn't go. So all the coincident data is telling us that people are no longer working. They certainly don't have the extra overtime. They're not getting the money on their gigs. Things are slowing down, and they're struggling. Everything we hear is that people are struggling, and it is going to roll over, and this affects you. So if you've got a house to sell, better sell it. If you've got investments in places that you can't justify why I'm here, then you need to either sell them or do a 1031 exchange. And if you're looking to retire and you haven't got enough money, an opportunity is coming to you that you only get once, maybe 3 times in your life. But you need to take advantage of that. So that means you need to get out of debt, save your money, get your credit pristine, and make sure that you protect your job, so your income stream, so we can buy some properties, because you're going to get an opportunity to do that and put some income into your portfolio. It's the income that drives us. You need $100,000 a year. Let's be brutally honest. You need $100,000 in passive income. And that's adding into your Social Security. You get Social Security, they take Medicare out of that. Say, oh, you get the $1,900, but you have to pay, $300 for your Medicare. So it's nowhere near as much. And I'm laughing because everybody, it's semantics. They paint this great picture, but really, you're in trouble. Most of us here are in trouble. So you need to have $100,000 in passive income, or you cannot retire. Now, you're going to get an opportunity to do that coming pretty quickly here. You're going to be scared to death because it's going to look like Grim Reaper out there. But this gives you an opportunity. Let me see if we can't finish this up and move forward here. So again, here's coincident data. I put this in. This is again from John Rubino this morning, talking about delinquent credit cards. I mean, holy cow! If you were working and everything was just fine, you'd be paying your bills. I mean, this is just the way it is. So I'm telling you, we have massive financial defaults coming. Real estate is going to collapse. We're going to have 2008 like on steroids. You've seen my other videos. If you like them, give me a thumbs up, subscribe. Now, the other videos are telling you can see, and we go to Federal Reserve electronic data set, and you can just see all the liquidity that they put into the system. They're not taking it out. And as much fun as it was when they put the money in, it's going to be brutally bad when they take it out. So, and we looked at this. Now we have at the markets right now, if you follow my last view, this liquidity is coming from somewhere. It's not coming from the Fed. It's coming from safe haven. That's coming from France, mostly, in Germany and Europe, because you can see the European Central Bank is losing $500 million in dollars, like 380 million euros. And then you can go into the Bank of France, and you can see they have $500 million in dollars. And you can go into RM2 and see that we've had $1 trillion added. That's what's going into the stock market, because that's return of your money, not return on your money. They want to get it somewhere where they're going to get their money back, or at least most of their money back. So that's what's driving the stock market, and our upper end just a little bit. So let me just open up the next slide, and then let's just talk about that. And this is me. So I'm going to tell you, if you missed out on the last couple run-ups, this is your opportunity to do this. You need income for your retirement. And remember, I keep saying this to people. They come into my office. Retirement is not an age. It is a financial decision. You can retire at 30 if you've got your money safe and secure and put in places that we can make sure that it's going to grow for you. You need the income. So it's the income that decides whether you can retire. We have a lot of people at 40, 45 years old. They have plenty of money. They can change their lives. You have this opportunity coming. Now, I'm with West USA here in Phoenix, Arizona. They're $1 billion firm. They do all of our back office, keep our compliance. You're welcome to call them. I work at the corporate office. You're welcome to call them. We'll set up an appointment, see if I'm a good fit for you and you're a good fit for me, and let's see if we can't change your life. My very best to you. Bye-bye now.